Good morning, Kevin. Welcome to our message today that we're
Yeah,
going to
good morning, Charlie.
title "The Worst Market Timer Ever." How's
Yeah,
that?
or I just put money in the market and poof,
Where'd it
it
go?
seems to have disappeared. What's going on?
That's exactly right. That's the perfect question because it's so weird to invest in our 401k or IRAs, whatever we're doing, and then, hey, all that has seemingly disappeared. Well, clearly it's not disappeared. And one of the ways, Kevin, I want you to share your thoughts too, but one of
Mhm.
the ways that I think about it really helps me is inside these mutual funds or exchange traded funds that we own are real companies. And I'm going to share a slide in a second about that. But even when I put my money in and I'm saving every month or whatever, I'm buying more shares of those companies. However, it appears that the money I'm saving is gone. But if we could show somehow or see on a regular basis, those shares are actually going to go up. You're going to own more shares of the company, especially when they're down. What do you think?
Yeah, so from a probabilistic standpoint, if you buy shares, they're probably going to be worth more in the future. The question is when. And so the other problem we have as human beings is we have a part of our brain called the insula, which is the part of our brain when we smell rotten garbage. It's the same thing that happens when we regret something. So that feeling of regret lights up the same part of our brain as when we look at like maggot garbage.
Oh,
So
nice.
so that kind of, so that's kind of a problem for us, Charlie. So you wake up, you look at your statement, you look at your website, and you see that you're down 15% for money that you just put in, and
Mhm.
it really can give you a visceral reaction. There's no doubt about that.
Yeah, absolutely. I'm going to share real quick, Kevin, the way I kind of frame this or what resonates with me in difficult times like this is hey, inside we've got these names for mutual funds that are kind of goofy. And in fact, I was at the conference, one of the conferences last week in Charlotte, and they're like, we don't know why we named it this way. It's just, sometimes they make sense, sometimes they don't. But I think when we see those names of a mutual fund or ETF and it's declining, it's like, hey, that thing is terrible. Whatever that thing is, get rid of it. Well, that thing is most likely um, owns these companies that you're looking at right now. In the US, a mutual fund or ETF, some of the top holdings are going to be just like these: Apple, Amazon, Microsoft, JP Morgan, then hundreds of others in the US. In fact, in the US, there's about 3,000 companies that we can own and usually do. And then in the non-US, you're going to see another goofy looking mutual fund or an ETF name, but these companies we've heard of, especially Nestle, right? We love Nestle, and then
Chocolate.
chocolate is right. BP, Royal Dutch, those companies, the prices will go down when things in the world happen that are scary. The prices go down, Kevin, because people get scared and they sell them. Supply and demand kicks in, and that price goes down when people sell.
Yeah. So Charlie, when we own companies, when we own something, we usually like it. So if you owned a company yourself and started a company, and somebody told you, "Hey, your company is worth $1 million," you're like, "I rock and roll." And then a year later, they come back to you and they say, "Hey, because of this, this, and this, because of market conditions, your company that you own and you sweat and blood and all that stuff in making this company, it's now worth $500,000." What would you do at that point? Would you say, all right, I'm going to sell it? It's worth less than it was last year. I'm going to
That's
sell it.
true.
No, you
That's a
wouldn't.
great analogy.
You wouldn't want to sell that company just because someone told you it's worth less than it was last year.
Yeah.
And these companies, it's not somebody that tells you it's worth less. It's the market or the collective wisdom of investors that are saying, hey, all of those companies that you loved last year, they're worth a little bit less this year. So then why do we want to sell them?
Yeah. Yeah, absolutely. That's a great analogy, Kevin, because as a business owner, you'd be like, I'm doing exactly the same as I was before. Nothing has changed. I'm still making money. Um, and so that's fascinating. That's a great example. One of the other things, Kevin, is do we actually want volatility? Is volatility good? And I mean volatility up and down. That's the definition. The one we don't like is the one that goes down. But do we actually want that? Or do we want a market that goes up all the time? Now, right now we're talking to savers, pre-retirees. Next week, we're going to talk to retirees about the sequence of return risk, which is exciting. But Kevin, let me just show you. I'm going to give credit to for these slides. This is Wealthfront. I borrowed their slides, and we got to keep that disclosure. This is what it looks like. I'm going to go through this really quickly because it's fascinating. This simply is a chart where the stock goes up all the time. You get 46.55 shares, $23,275.49. That's, again, if you invest $1,000 on January 2nd, and then the next 10 years, it turns into $23,275. So let's go quickly.
I want
this.
that stock, Charlie. Can
That's
I buy
awesome.
that? Yeah,
Goes up all the time. That's pretty
I
sweet.
like it.
Now, what about if it kind of goes up and like a stair step? And well, now I still invested the same amount. I've got a little bit more shares and a little bit more money, 24,209 versus 23,275. So the stair step actually helped me. And when I say stair step, let me reiterate and emphasize that means it went down as well as up.
So am I dollar cost averaging in this example here?
This is buying once every year, $1,000 each and every year. So you're buying on when the market's higher, you're buying when it's lower, but it's a stair step up. That's important to remember because this is like a typical investor. Now, what if the market was down all the time? Remember 24,209. Let's just round up to 24,210.
24.2.
24,210. Now, what if the market was down all the time? Or not the market, but this company you own was terrible for 9 years. And then the last year, it went up enough to equal the others in performance. But it was terrible up until that 1 year. You invested $1,000 every single year for 10 years. Instead, you would have 135.75 shares, a lot more than the other because you bought low the whole time. And your value at the end of that 10 years would be 67,000, almost 900.
So are you saying that we should buy losers and just buy them with an expectation of year 10, them going through the roof? I know you're not, Charlie. The point here is that markets going up when you're a buyer is really not what you want.
Yeah. And this is, I think, examples A and C are not natural. They're kind of, for example,
Sure.
You're not going to have a company do terrible for 9 years. Well, you might, I guess that's possible, but most likely it's going to be chart B, which is still better if you're an investor than a company going up all the time. And it's just hard for us to focus on the number of shares we own is really, really important. So I just wanted to, that helps me sometimes to not pay attention to the dollar number that I'm seeing.
Yeah, chart C is basically energy companies.
Yeah, that's a great point.
But who wanted to own them after year that your money was, went down?
Yes, that's right. Yeah, those are things that help me as an investor. Kevin, what about you? Any thoughts that you have?
Yeah, so one of the things, again, it's an emotional item that I see with people is that we don't want to be losers, Like if you said to somebody, do you want to be a loser investor? They would say, no, I don't want to be a loser investor. And then when they put their money in something, again, that regret when the money goes down, they're like, I don't want to be a loser. It's disgusting. I want to get rid of it. The real part of investing, though, is that we're all going to feel like losers at some point in time. So we're looking at Larry the Loser here. This is from Ben Carlson. I think it's called A Wealth of Common Sense. If I'm wrong, Charlie, correct me there.
You got it. That's
okay.
Exactly
So he wrote this back in 2014, the worst market timer. And again, we're using an example here because I think it's pretty fascinating that if you started investing in 1970 and you saved up your money and you on purpose invested at market tops, okay, this is the definition of being a loser investor. Okay. Every time the market goes to a top, I invest. And, a lot of investors that we talk to, a lot of our clients, Charlie, they will say that I just have bad luck in markets, like the market is out to get them or the stock is out to get them. The stocks in the market doesn't really care about you. I mean, it just doesn't. But let's say that you go ahead and invest at all the market tops. You truly are the worst lucked person in the world. I don't know if worst lucked is actually good English, but anyway, you invest $6,000 that you saved up for the market top in 72 and 87. You put in $46,000 that you saved up, and then the other two areas here. You would still have $1.1 million, $1.1 million when you retire. So this is an example of putting in $184,000 and continuing to do it at the wrong time, and yet you still have 1.1 million. What if Larry, the loser here, just invested all the money over just a series of equal times? Probably have more money than this. Now, there's no guarantee that the market is going to be higher in the future. There just isn't. That's the one risk we always take. But if companies are continuing, like the companies you said, Charlie, and companies that we don't know about, they continue to make more money, pay dividends, share buybacks, their prices increase over long periods of time. Why does it matter what's happening in 2022? Why does it matter that we put dollars in and it went down in the first 5 months of the year? I don't know why it matters, but it does seem to matter.
Yeah, it's painful to watch, and we know that, and we know this is this feels different than other times. You know, in I think in the economy, it is different. All the conditions are different. Russia, Ukraine, whatever event is happening, it's always going to be different. But we look to Kevin, we look to the principles of investing, and those principles are the same. You know, we expect companies to make money in the long term. Like you said, some of them may not survive, but we own thousands of them. So we know that we're going to be okay. And we know that most likely those companies will find a way to continue to make profits. And that's the important part here.
Yeah, and the other thing I would say, Charlie, is this volatility is a normal part of markets. This volatility is nothing new. I mean, volatility will increase for a while and then it will decrease. I remember a couple of years ago, we were all sitting around saying, there's absolutely no volatility. This is scary.
Yeah.
It's just scary. The market goes up time after time. So a lot of times people will ask us, is this crazy? The market is crazy right now. Well, the market's been crazy like this multiple times over the years.
Yep. Kevin, thanks so much, man. I hope this is valuable to our clients, and we appreciate you. We know this is a tough time and a lot of confusing information. So please reach out to us, call us, text, email, and we'd love to chat at your convenience. Thank you very much.
Thank you.